What I'm about to tell you could save your family hundreds of thousands of dollars or cost them everything if you get it wrong. I've seen people absolutely destroy their family's financial future with one estate planning mistake. Today I'm revealing the single biggest tax mistake people make when trying to pass their home to their kids. Before I explain this mistake and how to avoid it, hit that subscribe button. Stock Vibe is about protecting your money, protecting your family, and making sure you don't pay taxes you don't have to pay. Subscribe, turn on notifications, and let's make sure your family doesn't lose a fortune to the IRS. Millions of baby boomers own homes that have appreciated massively over the past 30, 40, even 50 years. You bought your house for $80,000 in 1985 today. It's worth $600,000, maybe $800,000, maybe more. You've built real wealth, done everything right, bought when prices were reasonable, paid down your mortgage, maintained your property, and now you're sitting on a gold mine. But most people have no idea how to pass that wealth to their kids without the government taking a massive bite out of it. Your house is probably your single largest asset for most Americans. Their home represents 50 to 70% of their total net worth. When you screw up the transfer of that asset, you're making a mistake that could wipe out a huge chunk of your family's inheritance. The biggest mistake is this: adding your children to the deed of your house while you're still alive. People do this constantly, thinking they're being smart, avoiding probate, making things easier for their kids. But what they're actually doing is setting their children up for a tax nightmare that could cost them $100,000 or more. Here's why this is such a disaster. When you add your kids to the deed while you're alive, you're making a gift. And when you make a gift of property, the recipient gets what's called your cost basis. Cost basis is what you originally paid for the property, plus any improvements you made over the years. Let's say you bought your house in 1980 for $100,000. Over the years, you put in a new kitchen for $30,000, added a bathroom for $20,000, replaced the roof for $15,000, and finished the basement for $25,000. Your total cost basis is $190,000. But today, after 40 years of appreciation, your house is worth $750,000. If you add your kids to the deed now and gift them the house while you're alive, they inherit your cost basis of $190,000, not the current value of $750,000. Now, let's say you pass away a few years later and your kids decide to sell the house. Maybe they don't want to live in it. Maybe they live in different states. Maybe they need the cash. They sell it for $750,000. They have to pay capital gains tax on the difference between the sale price and the cost basis. $750,000 minus $190,000 equals $560,000. In capital gains. At the current long-term capital gains rate, which is 15% for most people, but can be 20% if your kids are high earners, we're talking about $84,000 to $112,000 in federal taxes alone. If you live in a state with income tax, add another 5 to 13%. In California, your kids could be paying close to $185,000 in total taxes on a house you already owned, on wealth you already created, just because you made one mistake trying to be helpful. Let me say that again. If you gift your house to your kids while you're alive, they could pay close to $200,000 in taxes when they sell it. People do this because someone told them it avoids probate. Yes, technically it does avoid probate, a legal process that costs maybe $3,000 to $5,000 and takes 6 months to a year. So you're so worried about probate that you're willing to cost your kids $150,000 or $200,000 in taxes? That's like being so afraid of getting a parking ticket that you total your car to avoid the parking meter. Beyond taxes, you're creating other serious risks. Legal liability. If your kid gets sued for any reason, car accident, business dispute, anything, that house is now part of their assets and can be seized to satisfy a judgment. Divorce exposure. If your kid goes through a divorce, that house becomes part of the marital estate. It can be split with their ex-spouse. Your son or daughter's ex can end up owning half of your house. If your kid has creditor problems, files for bankruptcy, or gets into financial trouble, that house is exposed to creditors. Loss of control. Once you put your kid's name on that deed, you can't just take it off without their permission. What if you have a falling out? What if you need to sell the house to pay for long-term care? Nursing homes cost $8,000, $12,000 a month. What if you need that money and your kid won't agree to sell? You've given up control of your biggest asset at 70, 75, 80 years old. You're now at the mercy of your children, their spouses, and their financial situations. When you die and leave your house to your kids through your will or a trust, your kids get what's called a step-up in basis. That means the cost basis of the house is adjusted to the fair market value on the date of your death, not what you paid for it 30 or 40 years ago, but the current market value. Using the same example, you bought your house for $100,000, put in $90,000 in improvements. So your total basis is $190,000. The house is now worth $750,000. You die and leave the house to your kids through your estate. On the date of your death, the house is appraised at $750,000. That becomes your kids' new basis. If they sell the house 6 months later for $750,000, guess how much capital gains tax they pay? Zero. Nothing. Not a single penny, because there's no gain. The basis is $750,000 and the sale price is $750,000. Even if they wait a year and the house appreciates to $780,000 and they sell it for that, they only pay tax on $30,000 in gains. That's maybe $4,500 to $6,000 in taxes instead of $150,000 or $200,000. By simply holding on to the house until you die and passing it through your estate, you save your family potentially hundreds of thousands of dollars. The step-up in basis is a gift from the tax code. All you have to do is not mess it up by gifting your assets before you die. You can avoid probate and keep the step-up in basis by putting your house in a revocable living trust. This is how you get the best of both worlds. This is what smart people do, what wealthy people do. A revocable living trust is simple. You create a legal document, the trust agreement. Name yourself as the trustee, which means you control it. Transfer your house into the trust by signing a new deed, and name your kids as the beneficiaries who will inherit the trust assets when you die. During your lifetime, nothing changes. You still control everything. You can still sell the house, refinance it, take out a home equity line, do whatever you want because you're the trustee. When you die, the trust owns the house, not your estate, so it doesn't go through probate. There's no court process, no waiting, no probate fees. The house passes directly to your kids according to the terms of the trust, quick, private, and clean. And here's the beautiful part. The house is still included in your taxable estate for estate tax purposes, which means your kids still get the step-up in basis. You avoid probate and you avoid the tax nightmare. Setting up a revocable living trust costs money. Depending on where you live and how complicated your situation is, you're looking at $1,500 to $3,000 for a good estate planning attorney to draft the trust and help you transfer your assets into it. Think about what you're getting. You're avoiding probate, which could cost $3,000, $5,000 or more, and you're preserving the step-up in basis, which could save your kids $100,000, $200,000 in taxes. You spend $2,000 to save potentially $200,000. Every single homeowner who wants to pass their house to their kids should have a revocable living trust. Period. If you don't have one, you're making a mistake, and the longer you wait, the more likely it is that something happens and it's too late to fix it. Some people think they can add just one kid to the deed as a joint tenant with right of survivorship, figuring when they die, the house automatically goes to that one kid who can then distribute shares to other siblings. Wrong on multiple levels. First, same problem. No step up in basis for the portion you gifted. If you add one kid as a 50% owner, they get your basis on their 50%. And when they sell, they pay capital gains on their share. Second, you've created a family fight waiting to happen. One kid owns the whole house after you die, and the others have to trust that kid to be fair and share it properly. I've seen siblings who were close their entire lives stop speaking to each other over this exact situation. Here's exactly what to do. Step 1. Do not add your kids' names to your deed while you're alive. If you've already done this, talk to an attorney immediately about reversing it. Step 2. Find a qualified estate planning attorney in your state, not just any attorney, but an estate planning specialist who focuses on trusts and estates. Step 3. Schedule a consultation and set up a revocable living trust. The attorney will ask about your assets, your family situation, your goals. They'll draft the trust documents, you'll review them, sign them, and get them notarized. The whole process usually takes a few weeks. Step 4. Make sure your trust is properly funded. This means actually transferring your house and other major assets into the trust name. You need to sign a new deed transferring your house from your personal name to the trust. Your attorney should help you with this. Step 5. Review and update your trust every few years, especially if your family situation changes, more kids or grandkids. Someone dies, you move to a different state. Tax laws change. That's it. 5 steps. You can get this done in 30 to 45 days. And once it's done, you can sleep easy knowing your family is protected and you're not going to cost them a fortune in unnecessary taxes. Your house is probably the biggest thing you'll ever own. Protect it. Protect your family. Do it right. If this makes sense and you're ready to protect your family's wealth, do 3 things. First, subscribe to Stock Vibe and become part of our community. Second, hit that like button so more people can see this video and avoid this catastrophic mistake. Third, leave a comment below. Do you have your house in a trust? Are you going to set one up after watching this? Remember, you've worked your whole life to build wealth. Don't throw it away with one preventable mistake. Set up a revocable living trust, preserve the step-up in basis, and save your family hundreds of thousands of dollars in taxes. Don't gift your house while you're alive. Put it in a trust. Let your kids inherit it with a step-up in basis. Simple, smart, and it could save your family a fortune.